Overtime and tip deductions explained: what changed, who qualifies, and how the math really works. Overtime pay and tip income have always been taxed the same way as regular wages, even though they are not earned the same way. Overtime is usually earned during short bursts, like peak seasons, understaffing periods, or emergencies. Tips fluctuate daily based on customer behavior, not employer guarantees. Yet the tax system has historically treated both as if they were stable, predictable income earned evenly throughout the year. This mismatch created a long-standing issue. Workers who relied heavily on overtime or tips often saw higher withholding during busy periods, even though that income might not continue. Many ended the year confused about why so much tax was taken out, or surprised by how little the extra work actually helped them financially. The One Big Beautiful Bill addressed this problem temporarily. From 2025 through 2028, Congress introduced federal deductions specifically tied to qualifying overtime pay and qualifying tip income. The goal was not to eliminate tax on these earnings, but to soften the tax impact and encourage additional labor during a time of economic pressure, worker shortages, and inflation. This change is not permanent. It is not automatic, and it does not apply to all overtime or all tips. But it does represent a shift in how lawmakers acknowledge irregular labor income. To understand what this deduction really does, and just as importantly what it does not do, we need to walk through the mechanics step by step. Income is the total amount you earn. Taxable income is the portion of that income that is actually subject to tax, after adjustments and deductions. Under the new rules, overtime and tips are included in total income first. Only after total income is calculated does the deduction apply. For example, if someone earns $40,000 in regular wages and $15,000 in overtime, their income is $55,000. That number does not change. If $5,000 of that overtime qualifies for the deduction, taxable income becomes $50,000 instead of $55,000. The income is still reported as $55,000. The deduction simply reduces the portion used to calculate tax. This distinction is critical. It explains why this deduction does not eliminate withholding, does not remove reporting requirements, and does not erase the income from IRS records. It also explains why the benefit varies from person to person. The deduction reduces taxable income, not tax dollar for dollar. The actual tax savings depend on tax brackets and individual circumstances. The overtime and tip deductions only apply from 2025 through 2028. After that, unless Congress extends the provision, the deduction disappears. This matters because temporary tax laws often create long-term confusion. Workers adjust expectations, spending habits, and work decisions based on benefits that may not last. It is important to understand that this deduction was passed as a temporary incentive, not a permanent restructuring of the tax system. It was designed to address specific economic conditions at a specific time. Anyone planning finances around this deduction should do so cautiously. It may help during these years, but it should not be assumed to exist indefinitely. Understanding the time frame prevents unpleasant surprises when the deduction expires. Let's look at a clean overtime example. Assume a worker earns $50,000 in regular wages. During the year, they earn $12,000 in overtime. Their total income is $62,000. Under the temporary rules, assume $6,000 of that overtime qualifies for the deduction. The IRS still sees $62,000 in income. That does not change. However, taxable income is reduced to $56,000. If the tax on $62,000 would have been roughly $8,500, the tax on $56,000 might be closer to $7,600. That difference comes from the deduction, not from overtime disappearing. This is why people sometimes feel the benefit is smaller than expected. The deduction reduces taxable income, not the tax itself directly. One of the biggest sources of confusion around the new overtime and tip deductions is the expectation that paychecks will immediately increase. Many workers assume that once a deduction exists, less tax should be taken out of each check. In reality, that is rarely how deductions work. Paycheck withholding is based on estimated annual income and standardized withholding tables. Employers withhold taxes assuming that the income being earned will continue throughout the year. They do not typically adjust withholding for deductions that are applied later when the tax return is filed. This means that even though a worker may qualify for a deduction on overtime or tips, the withholding calculation often stays the same. For example, if someone earns overtime during a busy season, the payroll system assumes that overtime reflects a higher annual income. Taxes are withheld accordingly. The system does not know whether that overtime will qualify for a future deduction or whether it will continue for the rest of the year. The deduction comes into play when the tax return is prepared. At that point, total income is calculated, and then the deduction is applied to reduce taxable income. That is when the benefit shows up, usually as a lower balance due or a higher refund. This delayed benefit can be frustrating if expectations are not managed. Workers may feel like nothing changed, when in reality, the benefit simply arrives later. Understanding this timing difference prevents disappointment and helps explain why the deduction feels invisible during the year. To understand how the tip deduction works in practice, it helps to walk through a full example with real math instead of general explanations. Assume a worker earns $32,000 in hourly wages over the year. In addition to wages, they earn $18,000 in tips. Their total income for the year is $50,000. Under the temporary rules, assume that $10,000 of those tips qualify for the deduction. The IRS still sees the full $50,000 of income. That number does not change. The income is reported in full, and it remains part of the worker's tax record. After income is calculated, the deduction is applied. The $10,000 of qualifying tip income reduces taxable income from $50,000 to $40,000. Now let's look at the tax impact. If federal tax on $50,000 would have been approximately $6,500, federal tax on $40,000 might be closer to $5,000. That difference comes from the deduction lowering the amount of income that is taxed. The tips were not removed. They were not hidden. They were not ignored. They were included first and deducted later. This example shows why people sometimes underestimate or overestimate the benefit. The deduction does not reduce taxes dollar for dollar. It reduces taxable income, and the tax savings depends on rates and brackets. One of the most dangerous misunderstandings surrounding new deductions is the belief that they reduce scrutiny. In reality, deductions often increase scrutiny, especially when they apply to specific types of income like overtime and tips. The IRS does not stop tracking income simply because a deduction exists. Employers still report wages. Tip income is still expected to be reported accurately. Patterns are monitored year over year. If someone suddenly reports significantly lower taxable income without consistent documentation or explanation, it raises questions. A deduction does not excuse underreporting, late reporting, or inconsistent numbers. This is especially important for tip earners. Tips have always been an audit focus because they rely heavily on self-reporting. The existence of a deduction does not change that. In fact, it can make accuracy even more important because the IRS expects qualifying income to be clearly identifiable. One of the less obvious effects of the overtime and tip deduction is how it interacts with tax brackets and income-based thresholds. Many people assume tax brackets apply to all income at once, but in reality, income is taxed in layers. This means reducing taxable income can affect how much income falls into higher tax brackets. For example, consider someone whose taxable income normally places part of their earnings into a higher tax bracket. If the overtime or tip deduction lowers taxable income enough, some of that income may instead be taxed at a lower rate. The deduction does not change the bracket system itself, but it can change how much income is exposed to higher rates. However, this benefit is not guaranteed for everyone. Some thresholds in the tax system are based on total income rather than taxable income. Because the deduction does not reduce total income, it does not affect every calculation tied to income levels. This is where many misunderstandings occur. People often expect the deduction to unlock additional benefits or eliminate limitations tied to income. In some cases, it may help, but in others, it will not. The impact depends on how the specific rule is written and whether it looks at income before or after deductions. This is why two people with similar earnings can experience very different results from the same deduction. The structure of their income matters just as much as the amount. Understanding this prevents unrealistic expectations and highlights why this deduction helps strategically rather than universally. Whenever a new deduction is introduced, misinformation spreads faster than accurate explanations. This deduction is no exception. One of the most dangerous misunderstandings is believing that overtime or tips are now exempt from reporting. They are not. Every dollar earned must still be reported accurately. Another common issue is assuming the deduction applies automatically without limits or qualifications. The IRS does not apply deductions blindly. The income must qualify and the return must reflect that correctly. Overstating deductions or misunderstanding eligibility creates mismatches that trigger notices. Some people also assume that because the deduction exists, enforcement becomes lighter. In reality, targeted deductions often increase scrutiny. The IRS pays attention to patterns, sudden changes in reported income, deductions that appear inconsistent with prior years, or numbers that do not align with employer reporting all raise questions. Many penalties are not the result of fraud. They come from misunderstanding the law and applying it incorrectly. The IRS does not need intent to assess penalties for errors or negligence. This is why accuracy matters more than optimism. The deduction rewards correct reporting. It does not protect careless reporting. Understanding this distinction is one of the most important takeaways of the entire topic. For many workers, the overtime and tip deduction will help, but it will not feel dramatic. This is important to say clearly. The deduction is meaningful, but it is not life-changing for most people. The benefit often shows up as a smaller balance due or a modestly larger refund. It may reduce taxes by hundreds or in some cases a few $1,000s. It does not usually eliminate tax liability entirely. This matters because unrealistic expectations lead to frustration. People hear headlines and assume their financial situation will change overnight. When that does not happen, trust in the system erodes. The real value of the deduction is consistency. It allows workers who put in extra effort to keep more of what they earn during the covered years. It smooths out some of the harsh tax impact that overtime and tip earners often experience. Workers who understand the deduction are better prepared to plan. They are less surprised at filing time. They make smarter decisions about savings, spending, and additional work. Knowledge turns a modest benefit into a reliable one. The temporary overtime and tip deductions were created to address a specific issue, not to eliminate taxes on working income. They reduce taxable income, not earned income. They apply for a limited time, not permanently. Overtime, pay, and tips are still income. They are still reported. They are still subject to tax rules and enforcement. The deduction simply reduces how much of that income is taxed. Understanding this structure prevents confusion, disappointment, and mistakes. It allows workers to benefit from the law without overestimating its impact or misapplying it. When the deduction is used correctly, it does exactly what it was designed to do. It eases the tax burden on irregular income during a defined period without compromising the integrity of the tax system. Clarity is the difference between benefiting from the law and being confused by it.